Thanks so much for tuning into yet another episode of Navigating Through Uncertainty. We have a very special guest with us, Shankar Sharma, first global needs no introduction. Shankar, thank you so much for joining in, and it's an opportune time to have you simply because of the kind of uncertainties that seem to have crept in. The only caveat, Shankar, is that the last time that we did the interview, a lot of people told me that I did not counter a few of your points and I was agreeing to everything you said. So I'm going to play a devil's advocate on most of the things that we discussed today. But let's start with how do you see the current scenario, Shankar, considering the fact that we seem to be in a repeat template with a more severe undertone on the COVID front, but there is the vaccine around and the world seems to be doing a lot better.
Yes, so from if you look at it on a global basis, US, which really messed up on the healthcare front last year, there were a lot of horror stories coming out of the US on how badly broken the healthcare system was. But it seems under the new administration, they've got a handle at least on the remedial part, which is the vaccine part. So now US is, I think, 40 or maybe 45% coverage of the vaccine, which is really staggering considering the size and the spread of the country. So for a large population country, it is right up there. So they have gotten their act together on the vaccine front, while on last year, maybe because of the kind of leadership they had and very, very clear views on the leadership they had back then. I think just, the US just stands out completely, in this whole vaccination game. UK has done very well, but of course it's a smaller country. But a large country, US is streets ahead, nobody's even close. Of course, China being the home of the virus, you can say it is already covered, because I think when the virus was or discovered or made or whatever happened to the virus, there are many theories. At least they have a remedy already in place in Dubai. The Sinopharm vaccine has been around, widely used. So China also seems to be in a good shape. So two large populous countries have broadly figured out the solution to the problem. The third populous country, okay, so let's say that there's one in the middle too, which is Brazil, which was also in a bit of strife last several months, but that also the cases seem to have peaked and they're declining. So that also seems to have put some kind of lid on the problem. But the fourth populous country, I mean, it's obviously the most populous, but I'm sorry, talking in terms of sequence, is India, where everything has just gone south and just keeps going south. And what we are seeing unfolding here, beyond the lens of the stock market, which I never regard very highly from a maturity perspective, this has become a totally dystopian nightmare. Every day it has reached everybody's home. My sister was diagnosed with it, a few days back, and it's the same story everywhere across India. And that really should bother all of us beyond just looking at the market and saying the Sensex is very resilient. So I think India is in a bit of a pickle on this without any doubt.
Do you think the markets will worry about it a lot, or will the markets look forward the way they did the last time? The only disconnect is that right now the markets are no longer at the valuations that they were when we were at 7,500 on the Nifty.
My sense is the markets will look through this. Therefore, you may not see a repeat of what happened in March 2020. March 2020 was a surprise, although it wasn't a surprise if anybody was following the news through February. At least, we were not surprised with the fall, except 30% was not on the card, but a 5-10% fall was definitely on the card, given the magnitude of the unfolding problem last year. This year, for one, it is isolated to India. Second, markets are no longer in a surprise mode. Okay, so the data has been out there in India for the last 15-20 days, climbing every day. In some senses, the surprise element is no longer there, and which markets don't like negative surprises. If it's something which is already priced in, markets will look through that. So in my sense is the markets will say, okay, we have a script. What happened last year? Markets fell, markets recovered, and the fall was almost as if it didn't happen. I think markets will say, why even fall, or why even fall so much? So you cannot rule out a 5-10% fall. In any case, markets have rallied a lot. there was anywhere room for a fall for no other reason, just for the fact that you should have a correction in this kind of a vertical rally. But that I don't think will be a durable fall. I think markets will look through that and markets will rally back. And I think markets probably may not even get there by the looks of it. So broadly, markets have a script from the last time, look through the problem, and what lies at the other end of the problem is that generally companies which were doing well will continue doing well. So I think markets may not react as violently as it did the last time.
Shankar, you always said that, and it's obviously maybe to an extent fairly understandable that the markets will not crack because of a known known, which is completely discovered, but a slightly unknown known. Hitherto, the known knowns would be COVID cases or the yield and the interest rate issues. Now, what's your stand there, considering that for now that seems to be buried in the background, but you never know when it will come back? Do you reckon it will come back, and will it haunt equities by and large? And then we'll of course come to some of the other pickles as well.
So in particular, so here is a thing, okay? So India in its union budget for this year, which happened in February, decided to take a path which it has not taken before, which is basically a path of big fiscal expansions. Okay? India has typically been a very, very conservatively managed economy. All Indian finance ministers have always been worried about the fiscal deficit and the budget deficits. Through history, from the time I was born, the only comments you've heard prior to the budget is that there is no room for any expansionary policies, the fiscal room is limited and all that. That is a stance Indian budget makers have had for decades. And that is one of the reasons why India has been able to withstand global macro crises, which come once in a while. So like 97, 98 crisis, India, managed to, sail through that reasonably well. I mean, it wasn't hurt anywhere close to the way Thailand was hurt or Indonesia was hurt. And the same happened also, I mean, dot-com was more or less sectoral crisis, so that doesn't really macro crisis. 2008, India weathered the storm the best of any major economy, and it actually emerged from the crisis the strongest of any economy, and it emerged from it without doing any major stimulus or adding, most importantly, to debt. So India's fiscal conservatism has helped it through big crises in the past. This time, the policymakers decided that, look, we have been too conservative. It's time to basically at least lessen that conservatism by adopting a stance of growth. The deficits can expand for the interim period. Debt to GDP can go up. But if we are rewarded with increased growth, eventually all these things will work out for the better. In a way, they have borrowed from the book of a China or a US in particular, both these countries which have followed similar kinds of strategies, in which they have said, go for growth, never mind the deficits, never mind the debt, and we'll, at the other end of the tunnel, if there is more growth left, you have basically reduced your fiscal deficit because of increased revenue, and debt to GDP because of higher nominal GDP growth. India has gone down that path of China and America. Now, question is that a wise move? Time will tell. In the interim, the Indian balance sheet will have areas of strain, and one of the areas of strain will be obviously the borrowing program, which is why you might see yields, shoot on the upside, which is typically not such a good news for markets, because markets typically like low bond yields. I mean, that's like the sine qua non of a bull market: low interest rates, low bond yields, equities look more attractive, equities rally. Inflation is the other end, and of course, what is not helping is the global rally in food prices. So if you look at corn and you look at a lot of other agri commodities, they are enjoying a pretty significant bull run right now as we speak. And of course, industrial commodities, copper and oil and aluminium, etc., which are all inputs for a variety of industries, are all enjoying a tremendous bull market. It comes at absolutely the wrong time for India, when India would have wanted lower commodity prices so that it can get away with lower yields to be paid on its debt. But life is not ideal, so we have gone down the path of expansion. But guess what? Commodities don't don't know about it, and they are rallying like there's no tomorrow. All these things potentially can cause problems. Just to remain conservative, I'm a conservative person. I'm not a straight shoot first and ask questions later fund manager, or we as a house are very, very conservative, and our conservatism tells us that it's there are clouds out there which we need to be mindful of.
Even on the global side, you would reckon that yields could spoil the apple cart for maybe the US equities, or no, not quite?
So important thing is that yields maybe 1.55, 1.6 are not in absolute terms very high. Okay, so they are higher relative to where they got last year. I would tend to view that more as a normalization of an excessively low yield regime which we saw last year. Nobody believes or should believe that 60, 70 basis point yields or 90 basis point yields are supposed to be normal. That's not supposed to be normal. So, even a 2% yield or 2.25% yield on the US, 10 years, I would not reckon them to be anything out of the ordinary. That's where we were a couple of years back. So we just sort of went down, and then we are coming back up to what is still a very, very low overall in absolute terms yield level. And relative to those yields, so if you just look at it normally in a price to earnings ratio, the rest, everything being equal, a 2% bond yield should support a 50-time P multiple. Okay. Just for risk, it can support maybe 30 times P multiple, 40 times P multiple. In that context, US markets are not expensive. At least the non-technology part of US is not expensive. So where you can get hurt are the high-flying tech stocks, especially the second, third tier. So the mainline stocks are fairly cheap. But old economy stocks will benefit because they don't have much valuation compression risk. They're already at multi-year lows in terms of their valuation, multi-year lows even in case of many stocks and sectors in terms of pricing. So overall, I think the US is still okay, particularly the non-technology end of the market. I don't think that's a problem. The problem lies for countries with relatively weaker balance sheets, and India unfortunately falls in that category when it runs deficits on all fronts. So China can run a big deficit on the domestic front, a big debt to GDP on the domestic front, because as long as it can find enough savings to fund those, that debt, which is largely domestic debt, it's okay. India, because of its current account deficit, has reliance on foreign flows to fund that. So India's situation is a bit different from the US and China, but we are trying to use the same playbook as US and China. Time will tell whether that playbook plays out the way we think it should.
But does Shankar Sharma hypothesize that is how it will happen, and therefore are investments correlated to it shaping up in that fashion, and therefore maybe gains coming latter half of 2021, 2022? What is your playbook for India currently?
Our playbook is very simple. So, this year, as we speak right now, calendar year 2000, we had a blowout 2020. Again, because in part because of a cautious stance in February and March.
Shankar, sorry to come in, but didn't you guys score very highly on one of the counts? I think a PMSAIF report apparently placed you at the top percentile of the performers, if I'm not wrong.
I haven't seen that report, but obviously, us and the competition. So this year, current year to date, I think we are far and away the number one PMS in the entire industry. For the multi-cap, of course, small cap PMS, if small caps do well, we'll have a very great year, and then you can go south as well. But on a multi-cap basis, I think we are far and away the number one. I think we are up about 15-17%, while Nifty is around 14, 4 or 5 or 6%, something like that. But that is coming out of still a very conservative stance. So the point is not returns. I always repeat this, that people focus excessively on the wrong end of the market, which is returns and returns alone. Investing is about managing risk. There will always be risks to any investment situation. There is no world which is risk, right? We only, as analysts and as fund managers, we have to decide what is acceptable risk and what is unacceptable risk. Right now, the risks that we see in Indian equities tell us that this is no time to be aggressively chasing stocks which derive their businesses from the real economy or the domestic economy, which means that banks and financials fall in that category. They are always by nature highly leveraged. If you were to have a market cut of some kind, you will see the brunt falling squarely on the leverage end of the market, which is banks and financials. So we have cut back significantly in the last couple of months on our exposure. We anyway didn't have much. We cut back on that. We are quite comfortable with that. Other than that, we are fairly conservatively positioned, so that if the markets were to correct, while we might get hurt like anybody else, we will not lose as much money. So we are being conservative. Now that conservatism might prove wrong and markets say, screw it, we are just going to keep going up. We have, again, remember, this is a long-term game. It's not a 50-20. You make a run every ball. You cannot play investing in that fashion. You need a 6 every ball. Some balls need to be just played defensively out. That's what we are doing right now.
Yeah, no, which is great. But so therefore that stance, Shankar, leads you away from domestic cyclicals. And does it lead you to therefore investing into global cyclicals, or because your fund is not just India centric, you find other options elsewhere which are even better than the Indian global cyclicals? Because there are a bunch of people who, if they don't have the global options, have to choose between Indian cyclicals versus global cyclicals operating out of India. What is your stance there?
So again, so we do both ends of the markets. The India PMS is squarely India by necessity. We play to the best available choices. So there are global cyclicals that we have played quite successfully in India too, which is your steel plays and aluminium plays and copper plays. We've had them in good measure from actually, I think, from June last year, much before the commodity cycle became the flavor of the month or the quarter. So a JSW Steel or a Tata Steel or a Hindalco have done actually better than a lot of the IT names and the pharma names. And we've had all of them in our portfolios from the middle of last year. We continue to own them. We continue to like them. So there are ways to play global cyclicals sitting right here in India. That's not a problem. On a global basis, obviously, you're spoiled for choice. You can play a million ways, every single theme and thematic. So that's a different and a very long discussion. But for India-centric investors, we are playing the global cyclicals quite adequately within India itself.
So you are holding on to your positions in metals, I'm guessing from your answer.
Yes, very much. Absolutely.
Okay. What about the other, Shankar? There is a bit of, the jury is out on technology, especially after what TCS and Infi said. And a lot of skeptics say that if you look at FY22 or FY20, there is hardly any growth. And FY21 was a bombed out year any which way. So why compare that year growth numbers and say that double digit is good? Where are you on this argument? Are you bullish from a slightly medium-term perspective, or are you staying away?
No, we are bullish. We are very bullish on IT. So that in IT is all kinds of companies. There are the big mega ones like TCS and Infi, and then there are a slew of companies under them, which are not of the same size or scale, but they can. I understand this, that for a large company, cranking out 15% growth is a huge challenge, right? Because you have to add several thousand crores in turnover, which is equal to the turnover of many of the smaller companies within broadly the same space. You see, so we have played, while we have got a bit of emphasis in some of the larger ones, we played the tier just below that. So, without taking names, some of them, and they've been fabulous performance for us. So, IT is a little bit of it's not the same as a steel sector or not the same as an aluminium where you're more or less similar companies, but this has grades and shades. And while what is true for Infosys and TCS may not be necessarily true for the next year of stocks. And we played those, really happily. And our mind is very happy because we have played them.
Okay, fair call. Shankar, just one quick follow-up there. Since you kind of looking at this in such a granular fashion, is there a reason why a lot of or a bunch of these mid-sized IT companies at times are trading at valuations even higher than a TCS and an Infi? I mean, again, the bulls out there equate the growth numbers that they can give as to much higher over a sustained period of time in the next 4 or 5 years compared to the large caps. And they say now that most of the Indian IT third tier firms have crossed a particular threshold, they have a seat at the table to bag deals which are northwards of $100 million, and therefore they can continue to get such great multiples. What's your thought here, if you have one?
Yes, absolutely. I mean, we are in agreement there, and which is exactly what I was saying, that for them to, I mean, $100 million deal doesn't move the needle for a TCS or Infosys, but for the second, third tier, it can completely alter their growth trajectory. And in general, small caps in any space will trade at higher valuation than large cap, because there is greater growth potential available to them. So, I mean, that part is pretty axiomatic in investing. And remember one more thing, that unlike small caps in other industries, I'm talking on a broad swathe of industries, small caps, or let's say the mid caps in IT, are still very good companies in terms of pedigree and governance. So the biggest challenge you have with small caps or mid caps of other industries is you don't know what's going to happen. In IT, fortunately, because of the effect of these 4 or 5 major companies that they've had on the whole industry and the governance, the disclosure standards over 25 years, that you have companies which are very well managed with great systems, great structures, good boards, good accounting. So that one big risk, I'm not saying it's a uniformly applicable thought, but in general, happiest mind, you can trust them blindly on their governance. Growth, etc., we'll see. That's a different point. I think one major risk, or a Tata Elxsi, or there are many other companies, at least you will not have a risk that they come tomorrow, they will just blow up in your face like many other sector mid caps do. I think that's the other major thing. So as long as that thing is off the table for a number of these companies and growth numbers look good, I think it's a great space to be in.
Yeah, true that. I mean, there's probably one SAR instance in the whole landscape of Indian IT in the last 3 decades. So it's a very valid point that you make. Thanks for that, Shankar. Just taking a claw back on the point that you mentioned about local cyclicals or domestic cyclicals as well. Where are you on the whole discretionary demand? I think there is an argument being made that once we come out of wave 2, the kind of pent-up demand that we saw post wave 1 will not be the same, and naturally so. And therefore, to expect that discretionary consumption companies or stories will continue to show the same kind of or growth momentum that they showed in the second half of last year will be foolhardy. What are your thoughts here?
When you say discretionary, what are you including in that?
Well, let's take autos out there. Let's also take almost everything else, which is everything else but staples. Let's put it that way.
So you'll put a Hindustan Lever in that?
No, I won't put Hindustan Lever out there, but I would put the consumer electronic companies out there. I'll put autos there. And then, I mean, the last of the rung, which is so bombed out, the PVRs, Inoxes of the world, that we can't even talk about them right now. Yeah.
So yeah, I mean, automobiles, could be in a spot of bother for sure, because we don't know how long this phase itself lasts. Anybody who thinks this is going to get over soon, I think is being really, really super optimistic, because what we are seeing right now is a problem that really has no immediate solution. Okay, the solution should have been thought of 6-8 months back. We did not think of it enough or hard enough, and today we are in a situation of this kind, which means that all your consumption items which can be avoided, which is what discretionary means, can be pushed off the table. And in any case, a lot of these things have already been consumed by whoever wanted to consume them, right? A car or a bike, or a washing machine or whatever else, in large part already exists. It's really, you're looking for the marginal consumer to drive that. And I think you can safely say that we will have a problem for these kinds of companies. And again, by the way, you should not exclude the FMCG companies and all that from this fact, because there too, you have the scope to downgrade. It's not as if you necessarily need a Sunsilk shampoo to wash your hair. There are many cheaper brands out there, and this was our argument last year when we chose not to own Levers and the Britannias and some of the other Nestle. of the rest of the world, because our thinking was e-commerce is basically poison for these companies. Okay, because for them, their bargaining power vis-a-vis offline retail was huge. Okay, so you cannot run a store without having a lever on your shelf or a one of these FMCGs on your shelf, because they have a lot of customer pull. Now, when you move offline, online, the world becomes very flat. Okay, and it's very easy for any of the online retailers to put their own brand ahead of it. Okay, and if you go and see, you will see their own store brands available before, or on any search, before a Lever brand will crop up or a Nestle brand will crop up. That we saw back in April, May, that e-commerce is going to really cut growth rates for these old line FMCG companies. And if you look at the stock price movements, I mean, they have been absolutely the worst end of the market in the last 12 months' time. I see that trend not changing. I see that's a major threat. Online retail is a huge threat for these old guys, because store brands made by Amazon or made by Jio or made by Gophers, you can see that they're all Atta or any chocolates. You will search, that's where you will see them first, and they'll be like half the price, because the economics are very simple, Neeraj. I mean, in FMCG, your raw material cost is 5, 7, 8% of sales. Okay, manufacturing costs another 5% of sales. So 15, maybe 20% of sales is what your COGS is. So basically, you're left with 80% margin to spend on marketing and SG&A and all that. If you're a store brand, you can price it half the price and still make money, because you are not going to spend on the ad spend that a Lever has to do or a Nestle has to do. The economics are a no-brainer for a store brand, and I think that's a serious threat to this whole industry of the so-called Buffett-esque stocks with great moats and all that. I don't think the moat is that secure anymore.
Shankar, thanks for that last question, and maybe two rolled into one. I'm just trying my luck here. One, any thoughts on the year of IPOs or PSU divestment, if you have some thoughts there? And I really want you to dwell a little bit upon this wonderful piece that you wrote, I think in the ET, about how the machines are coming. And it was amazing to hear an active fund manager say that.
Yeah. So yeah, on the IPO front, markets have been buoyant globally, and people are right in their desire to go and sell stock to the public. I don't think you'll make a lot of money as an investor buying IPOs. I am never a big believer in IPOs. Very few of them are reasonably priced. Most of the time, most of the juice has been taken out by the bankers. So I'm not a believer in that. But it's good for the companies, and it's a buyer beware situation. So that's that. On the point of the machines taking over, I mean, when we say this, that has probably more meaning, because we have done it the old way, the old school way. And today, when we do what we do, and every day, like we spend several hours with our people, with the quant guys, the kinds of things data throws up is fascinating, to say the least. I mean, I get goose pimples just on the calls that, man, I mean, how on earth are we doing it the old way? You can dissect, parse every single nuance, in this market, to a degree that is unimaginable. And I firmly believe that this is not even the future; it's the present. And remember one more thing: what quantitative investment does for you is it gives you a consistent framework to look at your investing strategy. Most human beings are never consistent. You are never consistent. I'm never consistent. We always change our points of view. Our mood swings will be such that we might look at the same piece of information differently on different days of the week or the month or the year, right? Then the other thing, of course, is that we are so predisposed to a person, meaning if I like you, it doesn't matter even if you're saying utter rubbish, I have to support you. Or if I don't like you, even if you're saying the most rational thing, I have to oppose you. So those are our typical proclivities as human beings. The machine has no such problem. If I'm the biggest idiot in the world, but what I'm saying is right or logical, the machine loves me, and vice versa. It gives you a consistent wake. It cuts through a lot of clutter of our biases. That itself gives you a edge over the rest of the pack. Because think about it, it's like you're a specialty store, specialty restaurant, chef comes and cooks something very brilliant every day. But maybe he's not good on top form one day because he's had a fight with his wife or whatever. That day his quality will not be the same. The machine, if it were doing it, as long as it was coded right, will produce that souffle perfectly day after day, because it has no wife, it has no kids to worry about. I mean, I can go on and on, but bottom line, it is a whole new paradigm and it works brilliantly. And by the way, our results are a proof of that. It's not coming out of my genius or Devina's genius. I can tell you that much. The genius lies in the thought that has gone into coding the machine. After that, the machine does the job.
Well, that's candor. And maybe at some point of time, Shankar, we would love to do an entire episode on this. It's lovely to hear you on this.
Anytime. Yeah, absolutely.
But for today, thank you so much for this lovely insights, and stay safe, Shankar.
You too. You guys really need all the luck, man. I mean, I really, my heart goes out to everybody in India. I mean, I really wish everybody well. Please stay safe.
Thank you, Shankar. Thank you so much. And viewers, thanks for tuning into this episode of Navigating to Uncertainty.